Trading Post FX, where the world learns to trade.
Welcome to Module 4, Putting It All Together. In Learning Object 1, we will learn about rules, patterns, and probabilities, and the Elliott Wave trading map. Energy is the essence of life. Every day you decide how you're going to use it by knowing what you want and what it takes to reach that goal, and by maintaining focus. Said by Oprah Winfrey, O Magazine, July 03. I know for me, when I plan my day so that my time is managed, I find that I am more focused and able to accomplish my daily goals. My trading efforts as a result are better managed as well. That's what Module 4 is all about, planning our trades and trading our plan. The Elliott Wave principle is about learning the rules, understanding the patterns and setups, and assessing the probabilities. In a game like bridge, there are rules which cannot be broken. In Elliott Wave analysis, there are also 3 rules which cannot be broken. These rules can play a large part in defining our stop-loss levels. Chess is a game of pattern recognition and setups. The ability to see ahead several moves in the game is crucial to your success. Elliott Wave analysis enables you to learn the patterns so that you readily see trade setups and can anticipate subsequent market moves. There are some setups which are simply easier to see and trade. Poker is a game of assessing probabilities of the success of the cards in your hand. By learning the Elliott Wave targeting guidelines and wave personalities, you will be able to assess probable moves. You want to be in those high probability setups. One thing that all 3 games have in common is the need to focus and remain in tune with the game. By the same token, it is important with trading to remain in tune with the market and not lose focus. Don't let that little voice in your head interfere with your game. Plan the trade and trade the plan. It may be obvious to you that the use of the Elliott Wave principle is not a mechanical approach to trading foreign exchange, just as bridge is not mechanical and neither are chess or poker. Rather, it is an approach using probabilities while sticking to the rules and learning trade setups. This approach implies forecasting and prediction. While it is probably the most effective forecasting tool available, use it to project high probability targets rather than exact targets. Also, keep an open mind about the moves and always be aware of an alternative wave count. That means be flexible in your approach, stick with your preferred count, but when it goes wrong, your alternative count will kick in. Also, please know that even if your count is off, you can still make money trading the waves. Just know whether you are in a 5-wave impulse move or a 3-wave corrective move. Up until now, we have learned the tools of the trade. We have learned how to use the Elliott Wave to see where we are in the wave cycle and where we are potentially going. To master the tools of the trade, however, requires practice. If you are ready to continue this wave riding journey, then we are ready to introduce the Elliott Wave trading map. To determine whether you are ready for this section, please answer the following questions. What if I told you that you could learn how to trade the waves with multiple lots and know when to be fully invested and when not to be? Is that something you would be interested in? How would you like to become a competent, advanced trader and know it in your gut that you are one? If you answered yes to these questions, then you are ready to proceed. We will now proceed to learn the Elliott Wave trading map, which will move you forward to accomplishing the following goals. To learn to ride the Elliott waves using a systematic, predefined approach. To learn trade management with multiple lots on an Elliott Wave sequence with the Elliott Wave trading map. This is where we learn to trade in the zone and feel extremely competent in our trading skills. This level is accomplished because as a trader, we have put in the time required for research, planning, analysis, and practice. At this level, we learn to trade multiple lots by being fully invested when the market tells us to be, and the least invested when there are fewer trading opportunities. Here is a review of the naming convention introduced in Module 1. The naming convention that I use is consistent with Elliott's labeling, as he named 9 degrees of waves, which you can see in this chart. There are 9 wave degrees, beginning with grand supercycle, the largest degree, and ending with subminuet waves, the smallest degree that he observed. Each wave degree subdivides into waves in the smaller degree. For example, primary waves subdivide into intermediate waves, which subdivide into minor waves. Robert Prechter, in the Elliott wave principle, took Elliott's wave degrees and standardized a sequence of labels involving numbers and letters. He also added degrees as necessary. The numbers label the impulse waves and the letters label the corrective waves. The impulse waves alternate between Roman numerals and Arabic numerals. Labeling below minor degrees is in small case Roman numerals. Labeling above primary degrees is in uppercase Roman numerals. The corrective waves are labeled in small case for the Roman numerals and in large case for the Arabic numerals. The final column in the chart is labeled time frame. Here I labeled which wave degree applies to which time frame in the currencies. For example, the weekly charts are the intermediate wave degree. The daily charts show the minor wave degree. The hourlies show the minute wave degree, and the 15-minute is labeled as the minuet degree. It is merely a guide, but for those of you who want to start labeling, please use this nomenclature. There are other wave degree labels out there in the market, but in an effort to be consistent, I choose to follow Elliott's and Prechter's naming convention. In fact, subsequent charts in this course will use this naming convention. Just a quick observation on counting and labeling waves. It is more important to know whether we are in a 5 or a 3 wave sequence than to know exactly how to label the move. I first saw a version of the Elliott Wave trading plan in Robert Beland's Elliott Wave Principle Applied to the Foreign Exchange Markets, written in 1989. Bill Williams renamed it Profittunity Plan Trading in his Trading Chaos book, published in 1995. I have used this trading plan over the years and would like to share it with you because it is a great methodology to adjust position sizes depending on which wave we are in. It is a systematic approach to taking positions in a 5-wave and subsequent corrective sequence. We might intuitively know to take the largest position during a wave 3, but this plan quantifies the number of lots at each level. I have modified the plan as I saw fit and renamed it the Elliott Wave Trading Map. The Elliott Wave Trading Map is a roadmap for navigating the markets, which takes a set of vague ideas from your head and quantifies them into specific action steps. It is a written, well-analyzed, step-by-step process to guide you through planning a trade, taking positions, setting stop losses, and setting profit objectives. The plan applies money management principles so that you maximize your profits and minimize your losses. This can be compared to going on a cross-country trip from the East Coast to the West Coast without maps. Do you just drive west and know you've arrived when you hit the Pacific Ocean? Or do you follow a map to find the best way to reach your destination? To maximize time spent sightseeing while minimizing the drive. With your Elliott Wave Trading Map, you won't get lost. You will have clear instructions upon which to base your trading decisions. Keep this map with you at all times and use it on a daily basis. Without it, you might get lost. There are a few rules to get out of the way first, however. 1. Learn how to take losses. You are not a bad trader if you take losses. Quite the contrary. Taking losses is one of the greatest lessons you can learn. 2. If by chance you do get lost gracefully and choose another route. This is akin to having an alternate count in Elliott Wave analysis. You don't have to have the exact right count in order to take advantage of the waves. Keep an open mind as you learn how to trade the waves. 3. Practice riding the waves. In surfing, the bigger the wave tackled, the greater the chance of a wipeout. An occasional splash in the water, however, is the price one pays to master this science. 4. With money management principles in hand, visualize those impulse waves coming into shore and the corrective waves moving out to sea. The more you visualize, the more you practice riding those waves, the more able you will learn to read each wave characteristic successfully and be on your way to becoming a master trader. The first step in this approach is to determine your time frame for trading. I have illustrated 3 different time frames for you and have labeled them long-term position setup, medium-term swing setup, and short-term intraday setup. The long-term position setup uses the weekly price chart with the daily price chart for confirmation. The medium-term swing setup uses the daily price chart with the hourly chart for confirmation. The short-term intraday setup uses the hourly chart and the 15-minute chart for confirmation. Working with a top-down approach, let's take a look at the long-term position setup with the naming convention presented a few slides back. As you can see, the weekly chart can be broken down into its daily subwaves. So, the 8-wave pattern with 5 trend and 3 corrective waves are subdivided into 21 trend or impulse waves and 13 corrective waves, which happens to be a zigzag pattern. The trend move is drawn in blue and the corrective move is drawn in red. Also, the daily chart is superimposed on the weekly chart, so you can clearly see the daily subwaves. Furthermore, the trading time frame, if one were to trade this entire Elliott wave sequence, lasts between 3 months and 1 year, which is almost certainly a long-term trade. In our Euro-USD example, this long-term position setup took 11 months to complete, from the start of Wave 1 in January 05 to the end of Wave 5 in November of 05. This is the weekly chart with the appropriate labeling convention applied. Moving ahead to the medium-term swing setup, the daily chart is then broken down into its hourly subwaves. So the 21 impulse waves become 89 impulse waves, and the 13 corrective waves become 55 corrective waves, for a total of 144 waves, starting from the weekly and moving down to the hourly. The largest wave degree that we are starting with is the weekly chart, which is further subdivided into the daily and the hourly. The estimated time to trade this 8-wave sequence is 1 month to 5 months. In our Euro-USD example, this medium-term swing setup took anywhere from 2 months to 5 months to complete. Subwave 1 took 2 months, Subwave 3 took 5 months, and Subwave 5 took 3 months to complete. These moves are all part of the 5-wave sequence that you can see on this daily chart from January to November 05. Let's have a look at the short-term intraday setup to see the hourly chart subdivided further into the 15-minute chart. Again, the 5-wave sequence is an impulse or motive sequence in the direction of an uptrend. The corrective sequence is a 3-wave zigzag traded against the trend. Notice also point 0 and point T. Point 0 is the starting point for the 5-wave sequence, and point T is the termination point. The estimated time to trade this 8-wave sequence ranges from 1 day to 3 weeks. In our Euro-USD example, this short-term intraday setup took anywhere from 5 days to 16 days to complete. Subwave 1 of 5 took 5 days, Subwave 3 of 5 took 16 days, and subwave 5 of 5 took 13 days. Notice that waves 1 and 5 took 5 to 13 days to complete, both Fibonacci numbers. In the Elliott wave trading map, we begin by dividing our trading capital into 10 equal units or lots. That applies to whatever size account we are trading, super mini, mini, or standard account. We can use this money management system on any time frame. We've already reviewed the short-term intraday setup, the medium-term swing setup, and the long-term position setup. For purposes of this illustration, we will focus on the short-term intraday setup using an hourly chart with trades taken off the 15-minute chart. This methodology remains the same for all time frames. However, the trades will complete in different time horizons. For example, the short-term intraday setup could take as little as 1 day to complete up to 3 weeks. The medium-term swing setup could take between 1 month and 5 months, and the long-term position setup could take between 3 months and a year. These are only guides, by the way. This is where you can look at the currencies that you trade the most and see for yourself how long it takes an 8-wave cycle to complete on the various time frames. Now that we have mapped out the trading sequence, I am sure you are asking yourselves one important question, which is how to determine the start of the move, or point zero labeled on the chart. We have all the tools necessary to find point zero, the end of one trend and the beginning of another one. Projected price in the target zone for 5-wave sequence and internal subwave 5, wave 5 channeling technique, divergence between waves 3 and 5, and a change in direction of the current momentum. Reversal patterns such as rising or falling wedge, diagonal triangle, broken trend lines, double or triple tops and bottoms, 1, 2, 3 top or bottom, 8, 13, 21, and 34-day Fibonacci EMA filter, and candlestick reversal patterns. When you see at least 3 to 4 out of 6 of these trend-ending confirmations on the chart, you can assume that we have completed a 5-wave sequence and that a new 5-wave sequence is about to begin. So now that we have found the end of the trend, which starts us at point zero again, we are ready to begin with our Elliott wave trading map. All of the trades in the Elliott wave trading map include the following steps. 1. Determine the end of the trend, point zero. 2. Take the trade, determine entry points. 3. Establish the stop-loss levels. 4. Add on to the existing position at certain levels. 5. Take partial profits at target zones. 6. Close the position upon termination of the trade, point T. Let's begin with our Wave 1 trade. Before we begin, let's go over the trading nomenclature. There are 4 trades, one taken during Wave 1, another taken during Wave 2, a third taken during Wave 3, and a fourth taken during Wave 4. No new trades are taken in Wave 5. There is just profit taking. B stands for buy, S stands for stop loss, and P stands for profit. So Wave 1 trades are denoted B1, S1, and P1 for the entry buy and exit stop and exit profit levels. These trade symbols are for an uptrend, but could just as easily be for a downtrend move. To put this into context, we will be looking at the short-term intraday setup. These concepts are applied to the medium-term and longer-term setups as well, given the fractal nature of markets. The first trade, the Wave 1 circle trade, is to buy 3 lots when subwave 2 corrects 50 to 61.8% of subwave 1. The stop loss is below point zero, which is the beginning of Wave 1 circled. If we trade below the point zero, then our timing is off and we sell 5 lots to make back the money on the premature buy. We stop and reverse. We were long 3 lots, we sell 5 lots, making us net short 2 lots. Put the stop on the short 2 lots just above the entry cell. Profits should be taken at break even. Assuming we do not get stopped out, we continue to trade wave 1 circled of a new 5-wave move up. However, let's be clear that we could be wrong on our count, and it could merely be an ABC corrective wave up. Regardless, waves A, B, and C will look like waves 1, 2, and 3, since A waves are 5 waves, B waves are 3 waves, and C waves act very much like a wave 3. As this wave 1 circled unfolds, make sure to figure out the target for subwave 5 and use it as a guide to exit 2/3 of the position. Just as a reminder, use the end of the trend confirmations to establish the end of wave 1 circled. The first profit-taking level is when you count 5 waves up to complete wave 1 circled. At this point, sell 2 lots, holding on to 1 lot in case wave 1 circled extends. At the end of wave 1 circled, we have now taken profits on 2 lots, and we are still 1 lot long. We are now looking for an entry point to add to our position, which is the larger degree wave 2 circled pullback to between 50% and 61.8% of wave 1 circled. We buy 5 lots at this level, so now we are long 6 lots. This is our second buy trade, B2. Our stop loss remains below the beginning of the larger degree wave 1 circled, point 0, which is S2, at which point we stop and reverse by selling 10 lots to go net short 4 lots. Again, if our count is wrong, we will make back the money by going net short. If we do drop below the start of wave 1 circled, then the wave 1 circled is likely a larger degree wave 4 and the move down hasn't completed yet. If we are indeed in a wave 3 circled, we want to be long the 10 lots. So we wait for subwaves 1 and 2 to complete before buying again. This time we buy when the price takes out the top of subwave 1. We buy 4 more lots at B3, which says to buy 4 more lots on break of subwave 1. We are now long 10 lots. We are now long 10 lots during this wave 3 circled, and we raise our stop to below the beginning of subwave 1, which is point S3A. The new stop loss to sell 10 lots if price trades below the start of subwave 1. This is because one of the rules of the Elliott wave principle is that wave 2 cannot go below the start of wave 1. If we get stopped out, we have no position remaining. Once wave 3 circled moves higher and enters a 4th wave consolidation or correction, we place our stop loss below the top of subwave 1 to sell 10 lots. This is point S3B, which says, revised stop loss, sell 10 lots if subwave 4 trades below subwave 1 top. Any subwave 4 retracement at this point should not go below the top of subwave 1. If we get stopped out below the top of subwave 1, we lock in profits on the first 6 lots and pay the spread on the last 4 lots bought. One important point to note is that once wave 3 circled travels 100% of the distance of larger degree wave 1 circled, the next target is 1.618 times the distance of the larger degree wave 1 circled. Assume wave 3 circled continues moving higher. We now need to target the end of wave 3 circled using our wave 3 projections by counting the 5 subwaves for wave 3 and targeting using our Fibonacci targets that we learned in Module 2. When we reach our calculated goal, we sell 7 out of the 10 lots. We keep 3 just in case wave 3 circled extends. At this point, the 534 oscillator should be at its highest point, higher than the peak of wave 1 circled. On a smaller time frame, we should also be able to see divergence between subwaves 3 and 5 of the 3rd wave. To summarize the wave 3 circle trades, we start out long one lot from the wave 1 circle trade. We buy 5 lots at the bottom of wave 2 circled. We buy 4 more lots as we trade above subwave 1 of this third wave. And we are long 10 lots. Our stop loss at this point is below the top of subwave 1, where if triggered, we sell out our 10 lots, leaving us with no position. Assuming wave 3 circled goes according to plan, we look to sell out 7 of the 10 lots at the end of wave 3 circled. We use all of our tools to pinpoint the end of the trend to exit our 7 lots. Once we have locked in substantial profits, we take a step back and look to trade the last 2 waves, waves 4 circled and 5 circled. When wave 3 circled ends, we expect a wave 4 circle to unfold and look to go long again on the wave 4 circled retracement. That is circled wave 4. If subwave A of wave 4 circled makes 5 waves down, the pattern will likely be a zigzag with much lower prices, since A of the ABC retracement is 5 waves. If wave A is only 3 waves, then the wave 4 circled correction will likely be a flat, triangular, or irregular flat correction. When the 534 oscillator goes below the 0 line, the minimum requirements for the wave 4 circled correction are met. It doesn't mean the wave 4 circled correction is over, however, but it does give us a chance to start thinking about our re-entry point to be able to trade wave 5 circled. At point B4, we enter the 4th buy trade. After wave 4 circled has retraced 38.2 to 50% of wave 3 circled, you can buy 2 more lots depending on the strength of the wave 3 circled move. 1. If wave 3 circled is less than 1.618 times the length of wave 1 circled, then buy 2 lots. If wave 3 circled is greater than 1.618 times the length of wave 1 circled, then do not increase the position. The rationale is as follows. Usually, one of the 3 impulse waves in a 5-wave sequence is an extended wave, and this extension usually occurs in wave 3. Sometimes, however, it does occur in wave 5, and even more rarely in wave 1. If wave 3 is not an extended wave, the probability is that wave 5 will extend. If wave 3 is between 1 and 1.618 times the length of wave 1, then the likelihood of wave 5 being extended is greater. If wave 3 is extended, meaning that it is greater than 1.618 times the length of wave 1, then wave 5 will likely not be a very long wave. In fact, it can even be a failed or truncated 5th wave. Remember that extended wave 3s can extend up to 2.618 or even 4.618 times the length of wave 1. At point S4A, we are now long either 3 or 5 lots, depending on our analysis and whether we bought 2 more lots. At this point, we set our stop loss, and the ideal stop loss is below the top of wave 1 circled. We know that if wave 4 circled trades below the top of wave 1 circled, then an Elliott wave rule has been broken, and it is likely that our position is wrong. What does that mean in terms of the wave pattern? Well, our assumption was that prices would work its way up in 5 waves. If the market stops here and only does 3 waves up, it will most likely be labeled as an ABC zigzag correction. Therefore, a stop and reverse trade below the top of wave 1 circled makes a lot of sense. Since we are long either 3 or 5 lots, a stop and reverse by selling 5 or 8 lots would make us net short 2 or 3 lots. Once the stop and reverse is triggered, the price action will likely go much lower and we will be able to begin this exercise again, but we will already be short. At point S4B, we raise our stop loss. Assume wave 5 circled continues higher and trades up for subwave 1, subwave 2, and subwave 3. Since we are long our 3 or 5 lots, we update our stop loss level. We raise our stop to the bottom of subwave 1. If subwave 2 comes below the start of subwave 1, we break another Elliott wave rule and we must exit our entire position and stand aside. At this point, we sell all 3 or 5 lots. At point S4C, assuming all goes according to plan and subwaves 3 and 4 of 5 circled develop nicely, we raise our stop to below the top of subwave 1 of 5 circled. We know that subwave 4 on its correction of subwave 3 cannot go below the top of subwave 1. At this point, we exit all positions. Why would this happen, you might ask? Well, if subwave 4 goes below subwave 1, it means that this last move up in 3 waves is an irregular B wave of the previous wave 4 circled, and that a C wave will follow, which will take us below the assumed end of the wave 4 circled. So, take your profits and stand aside at this point. At point P4, this is where we take profits and sell all 3 or 5 lots. Assuming that everything goes according to plan and wave 5 circled travels in 5 subwaves, we are ready to take our profits. We look for 3 of the 6 confirmations we use to find the end of a trend. We exit all of our positions. We have completed our 5-wave trade to success. At the end of wave 5 circled, we take profits on our remaining 3 or 5 lots. Ideally, the trade is textbook and trades up in 5 waves with its ideal corrective patterns. If not, however, we have amply protected ourselves in the event we were looking for 5 waves, but the market gave us 3 waves instead. Now we stand aside and look to trade the ABC correction. In trading the corrective waves, we follow the same logic we used in trading the 5 waves up. But first, we use our Fibonacci tool on our charts and run it from the beginning of point 0 to the top of point T. This will give us some targets for the length of the possible retracement. If it is a wave 4, then the retracement levels to look for are between 38.2% and 50% of the wave 3 move. The wave 4 retracement should also fall somewhere in the vicinity of the previous 4th wave. If it is a wave 2, then the retracement levels to look for are between 50% and 61.8% of the wave 1 move. We are expecting an ABC circled correction, so we trade the A circled wave as follows. To start off, we watch subwave 1 down of A circled, which is usually dynamic in 5 waves, and we place an order to sell 3 lots on the subwave 2 retracement between 50 and 61.8% of the subwave 1 move. This is point S1, which says to sell 3 lots at 50 to 61.8% retracement of subwave 1. At point B1, we place a stop and reverse order to go net long just above the top of wave 5 circled. We place a buy stop order for 5 lots, making us net long 2 lots. The rationale is that it is likely that wave 5 circled is not over yet, especially if wave 3 circled was not extended. However, if all goes well with our trade, and if wave A circled subsequently turns into a 5-wave sequence down, we expect a zigzag correction and a deep move back down. At point P1, we are at the calculated end of wave A circled, when we have completed the 5 waves down. At this point, we buy back all 3 lots. If wave A circled ends up being only 3 waves down and reverses, then the correction is likely to be a flat or triangle and any variation. At this point, it would be prudent to buy back the 3 lots when subwave 4 trades above the bottom of subwave 1. A small profit will be locked in at that point. Now, assuming we did 5 waves down for the wave A circled, we are looking for a 3-wave B circled move up. At point S2, we look to sell 3 lots at the 38.2 to 50% retracement of the wave A circled. That is the likely target for the B wave, but of course we need to confirm it by counting the ABC subwaves of wave B circled. Now we are 3 lots short, looking to profit from that killer wave C circled, which has the same personality as a third wave move. At point B2, we place a stop loss above the 61.8% retracement level of the wave A circled for the 3 lots, because if the price trades above that level, we could be looking at an irregular circled B wave, which could take us above the top of wave 5 circled, or point 2. We then stand aside. A note on corrections is due at this point. Most traders make money trading the impulse waves and lose money on the corrections because there are so many types of corrections, from the simple zigzag to complex flats. We have illustrated this example with a zigzag correction, which is the easiest to trade, while pointing out the consequences if the correction is not a zigzag. However, the market spends a lot of time in corrections, so to be out of the market during corrections means that a trader will be without a position for more than half of the time. The times when corrections can be most profitable are when they are ABC zigzags and you trade the C wave. A wave 2 zigzag is potentially very profitable as well, because one can expect the wave 2 to correct between 50 and 61.8% of the wave 1 move. Wave 4s, on the other hand, typically correct between 38.2 and 50% of the wave 3 move and can often be quite complex. Now back to the chart. Assuming all goes according to plan, and we do in fact have a zigzag correction, we ride out the wave C circled and take our profits. We use 3 out of our 6 confirmations for the end of a trend to determine the end of wave C circled, and we buy back our 3 lots at P2. At the end of the corrective wave, there are no open positions, and closed positions equals 3 lots. Job well done. At this point, you deserve a break and a pat on the back for working through some very difficult concepts, but very exciting nonetheless. Here's the take-home message. Learn to use a systematic, predefined approach to the Elliott waves. Learn trade management with multiple lots on a trading map.